Great. So go back. So, ladies and gentlemen, here we are. The topic is dividend what year? Dividend policy. Ladies and gentlemen, I would want to start off by really letting you know that dividend basically is the proportion of the profit after tax. That portion of the PAT, profit after tax, that you are willing to, of course, share with your shareholders. So basically, this dividend here will be the return on your shareholders' investment. On your shareholders' what year? Investments. On your shareholders' investments. Now, we are told here that a dividend refers to that portion of a firm's net earnings which are paid out to the shareholders, A company's dividend policy dictates the amount of dividends paid out by the company to its shareholders and the frequency with which the dividends are paid out. When a company makes a profit, they need to decide on what to do with it. They can either retain the profit in the company, that is, retain the earnings on the balance sheet, or they can decide to distribute the money to the shareholders in the form of dividends, Ladies and gentlemen, between the two policies here, could you kindly tell me, if you are to be hired as a finance manager, of an entity, which policy do you think is good for your firm? Is it the one of not paying dividends at all, or in this case here, distributing all your earnings to your shareholders as dividends? Somebody talk to me this afternoon. So the question is, you have been hired, for example, as a finance manager of RCM. RCM has shareholders. So at the end of the year, you are able to get profits of, say, 10 million Kenya shillings. So the question is, should you retain the 10 million Kenya shillings here to finance your activities in the future, or go out and pay everything as dividends, or better still, strike a balance? Which policy, in this case here, will you go for as a finance manager? Abdi says retain. 50-50. Strike a balance, because if you don't do that, at the end of the day, you may not get a chance of sitting on that particular chair, or for example, of a finance director in the subsequent period. You may not get that chance. Why? For example, if it's a SACCO, go and tell SACCO members today that I'm not paying you any dividend. You'll be surprised, regardless of how your tongue will be sweet in terms of convincing them, ladies and gentlemen, that in the future, whatever they will be leaving behind will be helpful to them in the future. They will not accept. That proposal will automatically show you the exit door. So we need, in this case here, to balance. However, ladies and gentlemen, listen. There are firms in this case here which have got a different kind of shareholders. There are firms like Apple, the one that makes, in this case here, the iPhones. I saw somebody with an iPhone. The owners over there do not like what? Getting dividends. So it's a different kind of a clientele. We normally call it a clientele effect. To them, what they would want to see is their farm becoming big in the future. But remember, that kind of a clientele, ladies and gentlemen, globally, will be constituted by very few individuals who not want to be getting dividends every now and then. It's called the clientele effect, that if you decide from today, this is a firm whose shareholders have said, no, we don't want to eat our company today. No, we are looking at what we call the capital gain. So retain everything for our future. If you decide to start giving out some dividends, then automatically what will happen, ladies and gentlemen, automatically will be, you will lose that clientele. Those shareholders will start selling out their shares. So listen At the end of the day, it depends on the type of what year shareholders you have. We have those shareholders who believe in a bird in hand. Those shareholders who believe that a bird in hand is worth two in the bush. Those shareholders will come and tell you, hey, my friend, we don't want to hear that the future has got goodies for us. We don't want to hear that. That in the future we are going to make capital gains. In the future we're going to have several branches. No, as what you want because of our poverty levels, because we want these dividends here to pay our school fees for our kids, etc., pay us what we are able to see today. The capital gains, we can't see them. We can't see them. So in this case here, it depends on the type of shareholders that you have. But all in all, at the end of the day, what I've discovered for the number of years I've been attending some of these AGMs, ladies and gentlemen, people would always want a compromise. People would always want a compromise. In this case here, if possible, 50-50. 50-50. A compromise is always good, is always good, is always good. Retain 50%, give them 50% as their dividend. Now we have the various types of dividend policies. Ladies and gentlemen, we have what we call regular dividend policy. You have to take your notes, small notes. Regular. So under regular dividend policy, ladies and gentlemen, here shareholders at the end of the day will be knowing how much they will expect, how much they be getting even before you announce. Why? Because you are a regular with that kind of a policy. You are regular with that kind of a listen here. We are told regular dividend policy. Under the regular dividend policy, the company pays out dividends to its shareholders every year. Every year. This must be a blue chip company. A company in this case here, even if it's COVID, they're still able to meet the obligations. If the company makes abnormal profits, very high profits, the excess profit will not be distributed to the shareholders, but are withheld by the company as retained earnings. If the company makes a loss, the shareholders will still be paid a dividend under the policy. The regular dividend policy is used by companies with a steady cash flow and a stable earnings. Companies that pay out dividends this way are considered low-risk investments because while the dividends payments are regular, they may not be very high. For you to understand properly what regular dividend policy means, let's look at stable dividends first of all policy. A company following this type of a policy maintains a constant dividend rate irrespective of the actual earnings level. Under the stable dividend policy, the percentage of profits paid out as dividends is is fixed. Is fixed. So then at the end of the day, ladies and gentlemen, look at the DPS. The DPS, ladies and gentlemen, under stable dividends, we are supposed to know here, under stable dividends, that we have a constant dividend rate irrespective of the actual earnings level. Stable dividends policy. Under the stable dividend policy, the percentage of profits paid out as dividends is is fixed. Actually, this is not the proper graph for this. Allow me to explain this a little bit. Ladies and gentlemen, for stable dividends policy, will always have this kind of a situation where if our profits after tax fluctuates like that, if for example in this case here the profit after tax here is 10 million, profit after tax here is 5 million, then automatically our stable dividends will always move like that. Such that if we have our stable dividend policy, for example, being 10%, ladies and gentlemen, on this particular year, in terms of dividends, we'll take 10% of our profit, which is 10, which is 1. So again, we go to another year here, where we have profits after tax being 5. So here the concept of stability is premised on the concept of what here? A fixed percentage. A fixed percentage. A fixed percentage. A fixed percentage, which is quite opposed to what we call the regular. Regular, ladies and gentlemen, is not about percentage now. Regular is not even, ladies and gentlemen, regular is not even about what here, is not about how much profits you are making. For regular, once we say it's a regular, it is a regular. Even if in this case here we are having our profits here fluctuating. For regular, ladies and gentlemen, if we decide that we shall be paying, for example, 4 shillings every year, 4 shillings every year. So year number 1 will pay 4. Year number 2 will pay 4. Even if we make losses, we still have to pay that regular dividend. The regular dividend. Listen, listen. At times you will get this regular dividend coming this way. The regular dividend coming this way, where they will come and say that we are starting with a base of, say, 10. A base of 10. And then come next year, every other year, we shall be increasing our dividend by a constant percentage. So the percentage is pegged on dividend, not profit. Such that if you're going to be increasing our dividends by 10%, this is year 1. So year 2, ladies and gentlemen, year 2, it doesn't matter how our profit is. Year 2, we'll have to pay 11. That is 110% of the 10. Year 3, the same. So we keep on growing this thing, in this case here, by a constant percentage, so that at the end of the day, we'll have our regular line of dividends moving like that. You can see our regular dividend line is something you can project and say, in year number 3, this is the amount I expect as my dividends, regardless of whether the firm is going to make a loss or not. Or not. Great. We shall be able to differentiate the two very well as we move on. So we continue here. Irregular dividend policy. Under the irregular dividend policy, the company is under no obligation now to pay its shareholders. And the board of directors can decide what to do with the profits. Irregular. So this year we can pay 10. Next year we pay 20. Another year we pay 0, etc. We are not under anybody's obligation to pay dividends. If they make an abnormal profit in a certain year, they can decide to distribute it to the shareholders or not pay out any dividends at all, and instead keep the profits for business expansion and future profits, future projects. Ladies and gentlemen, the irregular dividend policy is used by companies that do not enjoy a steady cash flow or lack liquidity. Investors who invest in a company that follows the policy may face, in this case, there is a possibility of not receiving any dividends during the financial year. Now listen here, we have regular and what here? Extra dividends policy. Regular and extra dividends. Ladies and gentlemen, we shall be having this kind of a constant dividend. You can see no more dividend. When we get something abnormal, we increase. We go back to constant. When we get something normal, we pay more. We pay like a bonus, like that. So we are told here, especially when a company earns above average earnings because of any reason, but which is non-recurring in nature, it proposes an extra dividend over and above the regular dividend it pays. These extra earnings could be due to divestment. Perhaps they have sold some assets somewhere of a plant or business operation, and the company has no possible utilization of the same. So you decide, ladies and gentlemen, to give your shareholders a bonus on that year, in that year, etc., etc. Now, the most important thing that you're supposed to understand, ladies and gentlemen, for us at this level, is basically, even these forms of dividends, they are not bad for your exams. They are good for you to understand them. forms of dividends. We have what we call cash dividends, where you decide to pay dividends in the form of cash. We have stock dividends. Stock dividends, you decide to pay your dividend by giving what here? Your shareholders more shares. You give them shares in the company, additional shares. We have stock split. Stock split, ladies and gentlemen, of course, here now we shall subdivide the shares. We shall subdivide the shares here. So for example, we're being given some good illustration here. Example, 2-for-1 split. For one split. So the concept here is, ladies and gentlemen, of the share split, that we would want these shareholders at the end of the day. We are splitting shares for them to have more shares. So you're giving them again here what here, extra what here, extra shares, extra shares, extra shares. Share split. It's a form of what here, paying dividend. Of course, share split has got one disadvantage. When you split your shares like that, of course, like Equity Bank has done share split did some share split some time back. We expect because of the oversupply of shares now in the market, the share price will do what here? Will go down, will go down. Ladies and gentlemen, the other way in this case here that you could decide to reward your people instead of giving them, like now this number 5 is very common. Number 5 is very common. A scrip or a share dividend is an offer of shares in a company as an alternative to cash dividend. This is very important because under scrip, ladies and gentlemen, in this case here, we are issuing out what we call bonus shares. Bonus shares, bonus shares, bonus shares. You need to know under scrip or share dividend is an offer of shares, just like the stock dividends, Yeah. Stock dividends. So under a scrip, if somebody asks you what is a scrip dividend, it's an offer of shares in a company as an alternative to cash dividend. So under scrip, ladies and gentlemen, under scrip mode, we are giving you two options. Either you take a cash dividend here, or you take, in this case here, shares. So we're giving you an alternative scrip. Very important, very important. But all in all, you're giving out what here shares instead of, at the end of the day, you want people to take up shares because you may not be having the money. You may not be having the money. You may not be having the money. Great. So advantages of a scrip dividend, of course, ladies and gentlemen, the major thing here is about protection of your cash flows. You don't want, ladies and gentlemen, your cash flows to be impacted on negatively. So I would rather give you what here? Shares, instead of what here? Giving you money for dividends. That's number one. Number two, why would I want to give out shares as dividends instead of giving out money, ladies and gentlemen? It's because of what here? The gearing ratio. How do we get gearing ratio? To get gearing ratio, we normally take debt over debt plus what here? Plus equity. Debt plus equity. Debt plus equity. So when I give out shares, I'm of course increasing my equity because equity has got what here? Two components. Equity has got two components. We have shares, and then number two, we have what here? Retained earnings. So when I give out, ladies and gentlemen, shares, my equity is growing. And then of course my equity is growing because I'm going to retain, it's like I'm retaining that profit. So listen, when this grows, automatically the base is becoming bigger. And if the base becomes bigger, automatically we expect the total gearing ratio to reduce. Let me give you a very practical example. Assuming debt is 1 and the current equity, for example, is 2. So it means that the current gearing ratio will be 1 all over 1 plus equity, which is 2, which will be what here, somebody? Which will be a third. Assuming, ladies and gentlemen, that I increase this equity by retaining my profits and of course by issuance of shares. For example, I take this equity to something like 4. It means that the new gearing ratio will be 1 over, the debt is 1 plus equity, equity now becomes 4. So ladies and gentlemen, this will be 1/5. If you try out this, this will be 0.33. This will be 0.2. So of course you can see the effect. The gearing ratio has reduced. So when you give out shares, ladies and gentlemen, in the form of what here, instead of dividends, you are also lowering your gearing. You are lowering your gearing. So these are things we are supposed to know. These are things we are supposed to know. These are things we are supposed to know. So we are told, ladies and gentlemen, the first advantage here is that we are conserving what here? We are conserving cash. The second advantage is about what here? Decrease in gearing. The biggest disadvantage of scrip dividend, ladies and gentlemen, the biggest disadvantage of this scrip dividend, when you are giving out what here? Shares. When you are giving out shares, at the end of the day, we shall have so many shares in the stock exchange. So we expect to experience what we call dilution of our EPS, dilution of our EPS. Great. Now, ladies and gentlemen, here we have the dividend theories. I hope they're able to see my screen. I haven't even gone through their charts, because when you are sharing, at times you can't see the charts, but I can see they're okay. Great. Now, ladies and gentlemen, we have what we call a bird in hand theory. So for bird in hand type of shareholders, ladies and gentlemen, automatically these people would want their dividends today. Many say there is a clear link between dividend policy and the share prices. For example, it has been argued that investors prefer certain dividends now rather than uncertain capital gains in the future, a bird in hand. The size and direction of the share price change will depend on the difference between the dividend announcement and the expectations of the shareholders. This is referred to as the signaling properties of dividends. Ladies and gentlemen, remember, like in Africa, most of us, ladies and gentlemen, here are poor. We'll always depend on our investments to finance our immediate needs, our current needs. So when I invest in Safaricom, when they send me that small money, in M-Pesa, what do? Straight away, that goes to meet a particular need. Right? So meaning that in Africa, ladies and gentlemen, most of us will really prefer what here? These dividends to be received immediately. So meaning, ladies and gentlemen, that we are shareholders that we call what here? A bird in hand. And that is why you will get to see that all those organizations that pay their dividends normally will motivate shareholders outside here, will motivate investors outside here to go for the company's shares quite a lot. That is why if you see a company like Safaricom paying good dividends, the following day, what happens with their shares in the market? Their shares in the market demand goes up, which in this case here signals what here? A higher, an increase in price, That's what we call signaling, that you are sending the right message to the market. You are sending the right message to the market. Signaling effect. So what have we said about a bird in hand theory? Ladies and gentlemen, a bird in hand theory says that there are those consumers, and there are many, who would want their dividends today. They prefer to consume their company today. You know, when you are consuming money out of your business, you are basically finishing your company, as opposed to what here? Further capital gain in the future. And because these customers, these shareholders who prefer like that are many, ladies and gentlemen, at the end of the day, what will happen, ladies and gentlemen, is that if you pay dividends, because you have got many bird-in-hand shareholders out there, automatically they like that firm, they like the shares of that firm. So automatically, ladies and gentlemen, what will happen is that the share price of that company does what here? Goes up. Great. So we go to the next one. The next one, ladies and gentlemen, the other theory, which is quite important, is what we call the clientele. It's quite easy. Clientele, like they're telling us, Apple shares have outperformed the market massively in the last few years. This means that Apple shareholders are able to enjoy huge share price increases, capital growth. These shareholders cannot get such returns by investing elsewhere, so do not want their money back from Apple yet. They would want, in this case here, Apple to retain their money. Consequently, Apple dividend policy to date is 0 dividends despite its huge cash balances. So this is referred to as the clientele. They're those shareholders who've gotten stuck with Apple because of what here? That policy. A company with an established dividend policy is therefore likely to have an established dividend clientele. The existence of this dividend clientele implies that the share price may change if there is a change in the dividend policy of the company, as shareholders sell their shares to reinvest in another company with a more satisfactory dividend policy. So, ladies and gentlemen, I would want you to understand this concept very well. Under clientele, there are those organizations that will, of course, be paying some particular dividends. So, for example, I know companies like East African breweries, the blue chip companies, save for Corona, their dividends are quite regular. You are able to predict. Last year we got 10 per share. This year to be getting, in this case here, 11, 12, etc., 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 etc. So once you get accustomed to that kind of an environment, then you become a shareholder client. You are a clientele of their policy. Should they want to change that kind of a policy at once, what we will do is that you will run away. You sell your shares. And of course, when you are selling, when many of you decide to sell your shares at the stock exchange, we shall have oversupply of shares there. So the share price will do what here? Will go down. So anybody asking you about clientele, remember from the word go, companies will make promises that us, we shall be paying you dividends in this manner. Dividends in this manner. Once you make that kind of a promise, you will get some type of shareholders who will get used to that kind of a policy. So in the future, should you want to make changes because of the clientele effect, please let that change not be what here? Very drastic. If it's very drastic, you're going to lose most of your key what here? Shareholders. You're going to lose most of your key shareholders. So, ladies and gentlemen, I hope that has been helpful. But before I just sign out and go to a past paper question, do the past paper question that I promised, I would want us to discuss this. Discuss 3 factors that a company should consider when formulating its dividend policy. What factors, in this case, ladies and gentlemen, should a firm consider when formulating, if you're to be hired as a finance director, of RCM, ladies and gentlemen, what will be some of those things you will be able to consider when you are setting up a dividend policy? These should be coming from you. The points that you need to consider while setting up a dividend policy. These points should come straight away from you. I can give you 3. Liquidity is one of them. Liquidity. How liquid are we? If we are liquid, why don't we want to pay our shareholders? Why can't we pay our shareholders well? So liquidity is a big factor. How comes I'm not seeing any point from you, great students of mine? Or I'm the one who's not checking. What factors will you consider? What factors will you consider? What factors will you consider when you are forming? I like this one of government regulations. Government regulations. I like what Abdi is giving me, the gearing levels, gearing ratio also is reiterating on the same. So I'm here, all eyes, waiting for those points, The person saying profitability, you are very correct. Profitability, you are very correct. Person saying profitability, you are very correct. Imagine you guys are going to become finance managers. You're going to become finance managers, and I'm not seeing anybody here talking about the investment plan of the company. Investment plan, that is a key thing. Investment plan is a key thing. Investment plan is a key thing. I can now see very good points. I can see very good. You see, like this lady saying legal restrictions. Legal restrictions. Remember, the law does not allow you to pay dividends out of borrowings. I know here there must be directors of some SACCO companies who help their SACCOs to borrow for purposes of protecting their jobs. In the future, you'll go to jail because there is a law which says that you can only pay dividends out of profits or retained earnings. This year you may have made a loss, fine. But if you had some retained earnings, you can go back to that pocket and of course get some money from there, and then you do what here, and then you pay. But you can never pay. You should never pay. Actually, I should read this for you. This is very interesting. It's here. It is here. It is here. We are told, ladies and gentlemen, here, the general rules and the legal constraints, the three general rules are followed when paying dividends. Number one, the net profit rule. Dividends can only be paid from current / past earnings. Capital impairment rule prevents payment from the value of shares on the balance sheet. Capital impairment. We don't want to pay dividends in a way that our capital, our MPS will go down. So prevents payment from the value of shares on the balance sheet. And then we have insolvency rule. If you're insolvent, ladies and gentlemen, you should never pay dividends. So dividends cannot be paid when insolvent, or if the payment makes the firm to become what here? Insolvent. So ladies and gentlemen, I would want you guys to do me a favor. There is this question from our past paper that we started. The past dividend rates. We have to consider that. There is no way you'll tell us that you've been paying 10, and then all of a sudden you tell us in this case you're going to pay 0. No. So history. Our history is a good thing. Our history is something that has, like the capital market regulations. This is very important. Yes, it's a big factor. Yes. So ladies and gentlemen, we also, this one of the industry, I like the industry. There are industries, of course, which will pay more dividends than other industries. Right? There are industries where you'll be required to retain more because of the nature of business. Yes, I like that. This is a very good class. I like that. These are very good class. So, ladies and gentlemen, this is quite an interesting question that I would want us to do. It talks about dividend irrelevance theory. If you're writing your notes, you mentioned there dividend irrelevance theory. Dividend irrelevance theory as given to us by Modigliani and Miller. Quite different from what you guys know. As given to us by Modigliani and Miller. As given to us by Modigliani and Miller. So remember, under dividend irrelevance theory, whether you pay dividends or you don't pay dividends, the value of the firm will always be the same. So the concept here is that the value of the firm, the current value When you talk of O, O means current value. The current value of the firm is always the same regardless of whether you decide to pay dividends or you don't pay dividends. It's called the dividend irrelevance theory. Now, this concept of signaling, that when you pay dividends outside there, you are able to signal good information about future prospects of a firm, and as such, we expect the firm value to grow. These guys came and said, no, hogwash, irrelevant, useless. Useless. So for them, they said the firm value is always the same, regardless of whether we pay dividends or we don't. So great, ladies and gentlemen, here we are. Here we are. Here we are. So come there. We are reading Umoja group of companies belongs to a risk class of which the appropriate capitalization rate is 10%. Capitalization rate is cost of equity. Cost of equity or cost of capital. For here we shall use it as cost of equity. The company currently has in issue 200,000 ordinary shares selling at 50 each. The company is contemplating the declaration of dividend at the rate of shillings 3 per share at the end of the current financial year, which has just begun. Using Modigliani and the Miller proposition on dividend irrelevance, not firm valuation per se, not the normal Modigliani and Miller. No. Determine the price of the ordinary shares at the end of the year, assuming a dividend is not declared. I like this, ladies and gentlemen, because this is quite a funny one. Using the dividend irrelevance, we normally say PO equals the future dividend, end of year dividend, plus, ladies and gentlemen, the end of year price, discounted like this, discounted like that, discounted. This is not our usual provincial officer formula. No. This one is an important formula that we only use under dividend irrelevance. Dividend irrelevance. That if you want to know what is your worth in terms of share price today, just look at the dividend you'll be getting at the end of the year, D1, plus the market price of that share at the end of year 1. And then you discount by dividing this with 1 plus K. So we look at Roman 1. Remember Roman 1, no dividends, no or zero dividends, i.e. D1 equals 0, i.e. D1 equals 0, D1 equals 0, i.e. D1 equals 0, D1 equals 0. So then if that is the case, ladies and gentlemen, remember in this question, they have already given me P0. In this question already, I have P0. In this question, ladies and gentlemen, in this question, I have P0. They have told me the company currently has in issue 200,000 ordinary shares selling at, they're currently selling at, remember PO is the current market price per share. PO is the current market price per share, which in this case here they are telling us is 50. So ladies and gentlemen, if we go with the first policy of not paying dividends, then D1, don't get confused there, D1 will be 0. How about P1? P1, ladies and gentlemen, this is what they want us to look for. If you read the question, ladies and gentlemen, what they are telling us here is to, ladies and gentlemen, what they're telling us here in the question, the price of the ordinary shares at the end of the year, 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 P1 is what they want us to look for. But fortunately, we have KE. Fortunately, we know from some place up there that our KE is 10%. Fortunately, we know that our KE is what here is 10%. So they want us now to give them P1. So is there somebody who can make the arrangements, some adjustments there in a way that Olivia already has an answer? Yeah. So in this case here, our PO is 50, which will be equal to D1, that is 0, D1, which is 0, plus P1 that we do not really know the value at the moment, all over 1 plus K, KE, cost of equity, which is 10%. So 1 plus 10%, that will be the same as 1.1. 1 plus 10% is the same as 1.1, is the same as 1.1. So please try to make your rearrangements. If you try to do your cross multiplications very nicely, ladies and gentlemen, we have here 50 times 1.1 equals P1. Therefore, P1 will be 50 what here? P1 will be 55. P1 will be 55. P1 will be 55. Something that I'm so sure that all my students, if they were to get this kind of a question on an exam, all of them, it would have been a thumbs up. All of them. How about Roman 2 of this question? How about Roman 2 of this question? So Roman 2 of this question, ladies and gentlemen, the price of the ordinary shares at the end of the year, assuming that a dividend is now declared. Assuming that a dividend is declared. I like this. Assuming that a dividend is declared. But a dividend of how much? Remember, dividend declaration we are contemplating is 3. Assuming that a dividend is declared. So, ladies and gentlemen, that is quite an easy thing to do. This, what I need to do here is to come, ladies and gentlemen, here, and then give them D1. D1, if we declare the dividend, we can't declare any other thing apart from 3. And then, of course, the other factors will remain the same. PO will be 50. P1 is what we are looking for. And then we know cost of equity is 10%. And then they would want us, of course, to give them P1. So I know I may forget about many other things, but I'll not forget the formula of PO. I know that there are 2 formulas of PO. The one of DO into something, but this is a special one. dividend irrelevance. dividend irrelevance, ladies and gentlemen, what do we have over here? We know it is PO equals D1 plus D1 plus D1 plus P1 all over 1 plus KE. All over 1 plus KE. Ladies and gentlemen, if that is the case, then my PO here should be 50 equals D1 that they would want me to declare this time round, which is 3, plus P1 that I do not know, all over 1.1. I don't know whether they are able to see where I got my 1.1 from. I don't know whether they are able to see where I got my 1.1 from. Are they able to see where I got my 1.1 from? Yes, they have even gone ahead like Abdi to give me the answer. So meaning that they must have seen for sure where I got the 1.1 from long time ago. So in this case here, when we cross multiply, if we were to cross multiply here, what will I end up getting? What will I end up getting, ladies and gentlemen? If we end up cross multiplying, then this will be 50 times 1.1 equals 3 plus P1. Then this will be 55 equals 3 plus P1, implying that P1, if you take this to the other side, it becomes a negative. It is 55 minus 3, which will give me 52, which will give me 52, which will give me 52, which will give me 52. Something that I know all of us would have gotten very, very comfortably. All of us would have gotten very comfortably. All of us would have gotten very comfortably. So now we go to Roman 3, basically that particular number where the rubber meets the road. Number 3. Assuming that the company generates a net income, I should be reading from here. Assuming that the company generates a net income of shillings 2 million. and makes new investments of shillings 4 million during the period, show that under Modigliani and Miller, and Miller's assumption, payment or non-payment of dividends has no effect on the company's value. So, ladies and gentlemen, the most important thing here really will be for us to remember this formula that students keep on telling me that it's a bit complex, but I don't know how comes I normally see it to be easy despite my advanced age. Yeah, it's quite a simple formula. So, ladies and gentlemen, we have here under the current value of a firm will always be obtained by us taking new shares plus old shares. 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 New shares. New shares plus old shares multiplied by P1. So once I do it that way, then I'll have gotten what we call market capitalization. What is the market capital? The market capitalization arising out of what here? Our equity shares. It's a form of equity. The other way of growing our firm value, ladies and gentlemen, is the profit that we shall earn. The normal profit. So we'll come and add the profit here, add the profit there. And then, ladies and gentlemen, remember, according to Modigliani and Miller, when you make investments, in the current year, those investments normally destroy your value. You can only realize something out of it gradually as we progress. But otherwise, according to them, immediate investments we are making will always reduce firm value. And then you will come here and give us, ladies and gentlemen, 1 plus what here? 1 plus KE. 1 plus KE. You will come and give us 1 plus KE down there. So here, the major thing, ladies and gentlemen, will be for you to know what N stands for. N stands for what, ladies and gentlemen? N stands for new. Ordinary shares that must be issued. The new shares which you must issue to be able to finance your investments. To be able to finance your investments, what new shares, number of shares are you going to issue? What number of shares, new number of shares are you going to issue? So this stands for a new number of shares. This M stands for old number of shares. I would want feedback from you. Have you been able to explain there that N stands for new shares? Have you been able to write that N stands for new shares and M stands for what here, somebody? M stands for old number of shares or current number of shares or current number of shares or current. Thank you very much. Thank you very much. Now, where the problem, a little bit of a problem, challenge, where it comes here is in ascertainment of the new shares. The new shares. How do we really get to calculate these new shares? It's very easy. I will look at the investment. How much of investments are we looking at? Remember, under Modigliani and Miller, there are 2 ways of financing these projects. 2 ways. Either you issue new shares or you retain money. So for new shares, then what I'll do, I'll take the investment minus the retained earnings. Minus the retained earnings. Minus the retained earnings all over the price per share, which is P1. Price per share, which is what here? P1. So N, you look at what investments do you want to do. You subtract the component of this investment that will be financed through the retained earnings. So minus retained earnings, all over what here, somebody? All over P1, all over P1, all over P1, all over P1, all over P1. Very interesting. Very interesting. So, ladies and gentlemen, in this question of ours, if we don't pay dividends, when we talk of zero dividends, if we don't pay dividends at all, then what will be the retained earnings? Can somebody talk to me this afternoon? When dividends are zero, what will be the amount of retained earnings will we have? When we don't pay dividends at all, when we don't pay dividends at all, when we don't pay dividends at all, how much retained earnings are we going to have? How much retained earnings are we going to have? So, ladies and gentlemen, when we don't pay dividends at all, to be able to get retained earnings, we normally take the profit that we get minus what we pay out. Minus what we pay out, minus our dividends. So the profit which we generated from the question, ladies and gentlemen, from the question here, you'll have to give me 1 minute because I have to admit some students here. So we're saying that our retained earnings really is a function of two things. How much profit do you generate? How much are you paying out? If you pay more, then you retain less. So our retained earnings are here. It's profit minus dividends. Profit minus dividends. Like this is a zero dividends policy. If it's a zero dividends policy, then at the end of the day, this is what I will be having. The profit is 2 million. Dividends are zero. So in this case here, the retained earnings will be 2 million. So please come back here. So here then the new shares will be equal to the investment. What is the investment? What is the investment amount? Are you able to see some investments? Are you able to see some investments in this question? Peter tells me 4 million. Peter tells me 4 million. So the investments in the question, yes, I can see make a new investment of 4 million during the period. So I'm able to see some investments there. I like it that way. So the new investment, we have here 4 million. Retained earnings, we have 2 million. All over P1 for zero dividends policy, Could you kindly remind us what was our P1, zero dividends policy? Zero dividends policy P1 was 55. Zero dividends policy P1 was 55. So could you kindly give me an answer here? Kindly give me an answer there. For zero dividends policy, we got a price. Please try to write your answer in as many decimal places as possible. Here we prefer big number of decimal places. Big number of decimal places. Big number of decimal places. I'm going to finish this in 5 minutes. In 5 minutes. So we have here 36, 363, 36, 363, 36, 363.63, 636 like that. 636 like that. Thank you very much. So, ladies and gentlemen, having gotten that, really, my work will be about plugging in. My work will be about plugging in the formula here, the figures that I have. Now I have everything. Now I have everything. So, ladies and gentlemen, my VO here will be equal to, my VO here will be equal to the n that you gave me, the n that you gave me, this 36, 363 let me just read it again, the n that you have just given me, the n that you have just given me, that is 636 plus m. M, remember what we said about M. M stands for the old number of shares. Are you able to see the old number of shares somewhere? Are you able to see the old number of shares somewhere? The old number of shares in the question, yes, they are right. The company currently has got 200,000 number of shares. So, ladies and gentlemen, what we have here will be plus 200,000. So we have plus 200,000 multiplied by P1, who is able to give me the P1 to use. So the P1 that I shall be using here will be the P1 for zero dividends policy that you have just given me in a few minutes ago. 55 plus the profit we've generated as an organization. Profit over how much? Somebody. 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 Profit of 2 million minus the investment. Investment, somebody must have forgotten the investment value that we have been given. Somebody must have forgotten the investment value. It's 4 million. 4 million. And then, ladies and gentlemen, everything will be divided by 1 plus KE, which is 0.1. 1 plus KE, which is 0.1. So could you kindly move now slowly? Go up there and open brackets up there, times 55 plus 2 million minus 4 million, you say equals, and then you divide by 1.1. You divide by 1.1, and then you advise us, what value are we getting? Somebody, what value are we getting there? Somebody. So all of them are getting, at the end of the day, all of them are getting 10 million. All of them are getting 10 million Kenya shillings. Kenya shillings, 10 million. All of them are getting Kenya shillings, 10 million. So, ladies and gentlemen, having really gotten that, could you kindly do me a favor? This is the value of this organization if it decides not to pay dividends. If we say it's zero dividends, then automatically we shall be able to get our farm being valued at 10 million. What about the other side of the coin? The other side of the coin, what if we decide to pay dividends? So pay dividends policy, what will be the value of the farm? So number 2, pay dividends policy. Pay dividends policy. Pay dividends policy. Then what will be the value of the farm? Pay dividends policy. So pay dividends policy. Pay dividends policy. What will be the value of the firm? So I'm giving you a minute, you try that. I'm giving you a minute, you try that. So remember, we are paying dividends over how much? 3. We are paying dividends of 3. So D1 is 3. We are paying dividends of 3. So I'm giving you exactly 2 minutes. You try doing that as we wind up on this class. As we wind up of us get into. Number 1, when the dividend is 3, this is per share, then first of all, we need to give our examiner the total dividends payable. Total dividends payable will be the 3, of course, times the number of shares that qualified for dividends are the old dividends that we stayed with the whole year. New shares don't qualify for dividends. New shares to be issued at the end of this year can only qualify for next year's dividends. So then this will be 3 times the old shares, which were 200,000, which were 200,000, 200,000, which were 200,000, which were 200,000. So ladies and gentlemen, once I get this, how much are you getting there? Somebody, what you're getting here is 600,000, right? 600,000. So if that is the case, then I would want straight away to come and give them the new shares. Right? So how do I get the new shares? To get the new shares, we normally take the investment minus retained earnings, all over P1, all over P1. What I do not have here for sure is this retained earnings. I need the retained earnings, but I can easily get this. So my N will be equal to, the investment is 4 million minus into bracket. How do I get retained earnings? Retained earnings is a function of profit. How much profit was generated by this company? 2 million. 2 million was generated by this company. Minus this company decided to give out 600,000. The company decided to give out 600,000. So I can see somebody telling me that the retained earnings are 1.4 million. Come here and divide, ladies and gentlemen, this by the price at the end of year 1. The price at the end of year 1. The price at the end of year 1. Should we decide to pay dividends? Should we decide to pay dividends? Should we decide to pay dividends? What was the price? Somebody remind me this. Remember, if we decide to pay dividends, already we had gotten some price. 𝗀𝗂𝗿 𝗲𝗂𝗥, they are telling me 52. Should we decide to pay dividends, then 52 is the price which will be applicable. Is the price which will be applicable. Is the price which will be applicable. Then, ladies and gentlemen, if that is the case, why don't you go ahead and give me this figure? The new shares. So the new shares here will be equal to what? The new shares will be equal to what? The new shares, JB tells me 10 million, 10 million, 10 million, 10 million. Is there any other person who is getting the 10 million? Is there any other person who, no, 50,000, sorry. 50,000, 50,000, 50,000. So this one equals 50,000. And for sure, once, ladies and gentlemen, you give me this particular number of new shares, then I will be able very easily to give you the value of the firm. I will very easily give you the value of the firm. I would want to give you 1 minute to write that big formula. There's a big formula. Once you appreciate it, ladies and gentlemen, then you will never have problems. You will never have problems at all. That big formula. So I'm giving you exactly 1 minute. You write down that formula. I'm giving you exactly 1 minute. You write down that formula. You write down that formula. Write down that formula. Tell me, what do we have there? Write down that formula. Tell me, what do we have there? What do we have there? So, ladies and gentlemen, in my formula, this is what I will be having in my formula. My VO will be equal to, the new shares plus the old shares multiplied by P1 plus any profit we generate minus any investments we shall make in the current year, all over 1 plus KE. So the new shares, you guys have given me a figure of 50,000 for the new shares. 50,000 for the new shares. Plus old shares, 200,000. old shares, 200,000 times P1. P1, if my memory serves me well, P1 is 52, plus the profit we shall make as an organization this year. Of course, that profit doesn't keep on fluctuating. That profit is 2 million. Investments are 4 million. All over 1 plus 0.1. Now here, you have to move quite slowly, but wisely as a chameleon. So take care of the numerator first. Take care of the numerator first. Take care of the numerator first. Whatever you get, you divide by 1.1. Whatever you get, you divide by 1.1, and then you advise me, what are we able to get, ladies and gentlemen, here? A lot of people are telling me 10 million. A lot of people are telling me 10 million. 10 million. So, ladies and gentlemen, is there anybody who is able to deduce some conclusion here? Is there anybody who is able to see some pattern? What I'm able to see is that regardless of what we do in form of dividends, whether you pay dividend or you don't pay dividend, ladies and gentlemen, the value of the firm will remain what here? Constant. I.e., value with dividend equals value without dividend, which is what here? 10 million. 10 million. That the dividend policy of the firm, as Lokai tells us there, dividend policy of the firm does not matter. Dividend policy of the firm does not matter. Does not